Hi, and welcome to Hedge Fund Manager. I'm Karl-Mikael Syding, and we are continuing with a deep dive into LVMH. So what we now want to do, after having calculated a normalized platform in terms of earnings per share, we want to calculate the annual returns going up to that time point. And for that, we need today's share price, P0. We need our estimate for the share price in N years, for example, 4 years. And then we just use a simple CAGR formula. You don't have to memorize it. It's just very simple. It's a geometrical return formula, simply estimating like if what falls out here is for example, 15%, then it just means that you will get 15% per year in a compound way. So 1.15 times 1.15 times 1.15, that will be your total return. And what you do is you actually move, you do it backwards. You estimate P in 4 years, divide that by P today, and take the fourth root out of that, not square root, but the fourth level root. And then you add the dividend yield estimate to arrive at the total annual return. And from there, you also want to estimate the relative risk level for the company in order to come up with a good risk-adjusted assessment and being able to rank this opportunity to in relative to other opportunities. For example, just a broad-based index fund or similar companies or completely different companies. It could be one of my favorites in terms of Novo Nordisk or Google, Evolution, Meta, not least, Spotify, etc., etc. And then you add the company to your list, your short list, your watch list of interesting opportunities, and you find various ways of combining the risk level and the opportunity, the upside potential, and then simply invest in the one which has the best overall characteristics, perhaps the least risk, above an absolute threshold in terms of performance. So even if you have something with a very good ratio of performance relative to risk, it might still be very uninteresting because it has an absolutely low potential level. So for example, 5% potential per year, that would be completely uninteresting for me and hopefully for you too. So it should always be more than 15% potential per year to even be considered an interesting investment. And that is not really even taken into account any margin of safety for poor analysis or bad luck. So we can move on to this just quick overview of how to make this calculation. So we have the price today of LVMH, price in 4 years, and how did we arrive at 1,063 for our price level in 4 years? Well, we have today's EPS growing by 15% per year for 4 years. What we actually did was something slightly different. We estimated a bit of a trough and then a bit of an acceleration. So maybe this should not actually be 44, but it's a good enough estimate, given that there are a lot of uncertainties here, for example, money printing, which really could propel LVMH upward, and they should also be able to take a lot of market share in these turbulent times and then accelerate out of that, things that we also saw around the COVID crisis, which was in the end very, very good for LVMH, and I foresee something similar this time. And anyway, so we end up with an EPS estimate here of 15% higher per year for 4 years, or 44. and using MoneyChimp, we can estimate based on our assumptions from there in terms of growth rates and discount rates, a warranted or likely price earnings ratio. Here we have I have entered 24.2, and then that 44 times 24, it's 1063 as my estimate of the future price per share. This amounts to, well, using this just a simple CAGR formula, C16 and C5, up to the power to 1/4 for 4 years and -1. It's just how it's done. That it means a CAGR of 22%. We have a dividend right now of 13, which compared to 15 is 2.68%. And I'm assuming that they will be able to keep up the same type of dividend, the dividend yield every year, so that it will grow in line with the stock. Maybe we should actually add, estimate a slightly lower dividend yield on average, because the stock price is likely to grow faster, as we can see here, than the actual fundamentals. Just entering 2.5% there, we end up with a total annual return of 24.2%. And how would that compare to other alternatives? Well, we don't know just yet, but we do have at least one typical data point, and the one that we could calculate as we did in this MoneyChimp model. But we can also just simply remember that the market has, when bought at the average level, provided us with a 10% total annual return. So whenever in history that you paid 15 times the earnings multiple for the market, over the coming 10 to 20 years, and actually for forever, you got a 10% annual return. And I would say that by definition, the market risk and the market required rate of return should be 10%. So by definition, the market has a risk-adjusted, let's call key ratio of 1.0. So the 10% return with 10% risk, and that is when bought at a price earnings level of 15. And the average company, I would call that 15% risk. You could call it whatever you like. You could call it 12%, but 15%, I think, is it's because you should have a required return for the average company of 15%, and then the combination of 15% annual potential and 15% risk, like the relative risk number that you estimate, then that also becomes a ratio of 1.0. So that is equivalent with buying the broader market, simply because you have more room for there is idiosyncratic risk in a single stock. And therefore you should always require a lot higher return. Maybe 15% is a little bit excessive, but I would myself never make the effort or take the risk or all this going through all this trouble to invest in just a single stock to get less than 15% potential, when I can get 10% on average simply buying the markets, and thus diversifying a lot of trouble and risk away. I would say that LVMH has a risk level of maybe 10% lower than the average company, simply because it's retail, it's a global hegemony, they have almost a monopoly situation. We know that their end markets in terms of rich people is growing more stable, and they have a really strong pricing power, which means that the risk of a permanently lower profit than the recent trajectories, that risk is quite a bit lower than for the average company in let's say the S&P 500, and therefore the risk level is, I would say, maybe 13.5. That means that we have here a ratio of annual total returns to the risk level of, let's call it 1.8. 8, and the market's level is, as we said, 1.0 by definition. And that means that this LVMH is ranking very, very good in terms of risk-adjusted returns.